The statement of cash flow is the fourth financial statement. It completes the picture of the company that we have painted so far with the balance sheet, income statement, and statement of stockholders' equity. Remember, that's the one that started off as the statement of retained earnings and then morphed into the statement of stockholders' equity. The statement of cash flows is all about cash. It is structured to tell us where our cash came from and where it went. It is one that I look at closely when I am trying to decide if I should invest in a company. We just introduce the statement in this course. We don't cover everything about it. There are two formats used in preparing a cash flow statement: the direct method and the indirect method. We only cover the direct method in this course, as the direct method will give you the basis you need for understanding the cash flow statement. The direct method shows the pluses and minuses to cash in three categories: operating, investing, and financing. The indirect method format does the same thing, but in the operating section, we start with net income and then convert the net income from the accrual basis to the cash basis. As I mentioned, the cash flow statement shows cash ins and outs in three categories. First, the operating activities include cash received and paid for the day-to-day activities of the business. Cash inflows for this area are receipts from customers. These are cash sales or cash payments on accounts receivable, interest, and dividends. Cash outflows in this area are cash payments for your operating expenses, such as wages, supplies, rent, and insurance. The second category is investing. Investing activities include cash paid for the purchase of investments, such as stock and bonds and long-term assets. These stock and bonds are investments. They are not the stock and bonds that you as a company would issue. Cash inflows in this area would be the cash you receive when you sell the investment or the long-term asset. The third category is the financing activities. This includes cash you get from loans and the sale of stock. When you pay off the loan, the payoff is an outflow in this area. But the interest paid is considered an operating expense in the operating activities. However, dividends paid are considered an outflow in the financing area, as they are not an operating expense of the business. Let's take a look at a simple direct cash flow statement. You start with $12,000. That is the cash you started the year with on January 1st. You end the year with $2,000. That is the balance in the cash account on December 31st. You show it here and on the balance sheet as the asset cash. So what happened? How did we go from $12,000 to $2,000? Is this a problem? We need the cash flow statement to tell us. The first thing I would look at is the net cash from operations of $30,000. I want to see a plus here. That tells me that the cash flow from the normal operation of the business is positive. That's a good sign. A negative cash flow from operations is a red flag for potential problems in the business surviving. As I analyze the statement further, I see that the company paid $36,000 for a new vehicle, $22,000 for equipment, and it looks like they refinanced some loans where they paid off $34,000 in loans and got a new loan for $32,000. As you can see, I now have a good picture of this aspect of the company. How much cash a company generates is critical information to investors and managers. But we need to know the details as to where it is coming from. We may have a lot of cash at year end, but it may all be from loans, and we could be losing money from our day-to-day operations. The cash flow statement will point this out and help us make educated decisions. My rule of thumb is be wary of a company with negative cash flow from operations.